Hey, our friends. Marshall Moore here at On Top Credit Union. I am sitting down today with Dave Sprague, a retirement income certified professional, and we are going to be talking about the big question that comes up often. When will I be able to retire? And what do I need to know in order to make sure that if I am retiring or already retired, that everything is going to be okay? Dave, thanks for sitting down with us today and bringing some of your expertise to the table.
My pleasure, Marshall. Thank you for having me along. And I'm excited about the topic today because it impacts everybody.
100%. And like we said, that is the big question that comes up in people's mind. Oftentimes when we're thinking about our financial futures, there's this balance. Like, I want to be able to live for today, but also to make sure that I'm going to be okay in the future. And there's often also a little bit of uncertainty surrounding the numbers.
Yep.
We feel a little bit, we feel our shoulders kind of coming up when we start thinking about the numbers. And we're hoping to be able to get into some of the details today that make us feel a little bit more competent with the numbers and give us the confidence to know that everything can be okay. So if somebody comes to you with that question, like, where do we even start? I know that I want to eventually be able to retire, whatever retirement looks like for me. How do I start, and when should I actually engage in the conversation with somebody like you?
That's a great question. And I actually wrote down some notes because this could go on for an hour. And we're going to split it up into three different segments if it works for you. First, we'll talk about how to answer that question and whether you're in retirement, close to retirement, or you may be in your 30s or 40s and just trying to set a target. The process is the same to figure out what number you need to get to live the way you want to live. So we'll certainly hit on that. And then we'll kind of move into, okay, now that we know the number, what are the risks that I need to address to make sure I have a successful retirement? And then we'll talk about the three overarching strategies to generate retirement income. So I'll just kick it off with the different types of questions. When can I retire? How can I retire? Do I have enough money to retire? So we hear the when can I retire question more from the younger folks that are sitting there, and you've heard of the FIRE movement.
Oh, yes.
Financial independence, retire early. So there's a lot of focus on it. And contrary to popular belief, it doesn't mean you have to live in your mother's basement and eat granola bars to get there. But you do have to you do have to have a goal, or else you'll never attain it. We've heard that millions different ways. So as far as those questions, you go through the same process to develop the answer. And the first thing I'll point out, though, is when you're asking about when can I retire, let me take care of the easy stuff first, which is the emotional readiness. I say easy, it may not be that easy. A lot of folks focus on the number they need and not what happens when you retire. And study after study after study shows that people are unhappy in retirement without some sort of goal or purpose in life. So what I would suggest to folks, before they even start worrying about the number, start envisioning what your retirement looks like. What are you going to do if you don't have to go into the office at 9 to 5? What are you going to do if you don't have to answer emails at 8 in the evening or something along those lines? Because that's a big void to fill. And if you don't have something to fill that void, then it's going to make for a miserable existence. And this is kind of the soft, touchy-feely stuff, but it's important. Nobody wants to retire to be less happy than when they were working. And so I think that's important. As far as the financial readiness part of it, a lot of people over-engineer this. A lot of people in my industry over-engineer this. So I'm going to hit on something that will not give you a specific number, but it's going to give you a number or tell you whether you're in the ballpark or not. And if you are close enough, then fantastic. As you get closer and closer to retirement, think of it as a decision funnel. The further you away, the more of a ballpark guess it's going to be. The closer you get, the more you need to sharpen your pencil. And I would also suggest to folks that I've never been a huge fan of people in their accumulation phase paying for ongoing advice, because you really don't need that. You might need a little bit of coaching here or there, but when you're younger and acquiring wealth, It's about keeping your costs low and making sure you keep feeding the monster, right? And you do a lot of work on that with the folks you work with. And so that's great. As you get closer to retirement, you start having retirement strategy questions, and there's not a specific point in time. A lot of people will point to 50 and older as getting to that point. So if you start having a conversation, I would say, let's say you're a traditional retiree and you want to retire mid to early 60s. I would say start having the conversation around your early 50s, and then start making portfolio adjustments about 5 years out. You want to start looking at de-risking your portfolio and those kind of things, and getting it set up, because you're very much in your pre-retirement phase at that point, if that makes sense. So that's great. So that's when you need to engage with an advisor. That's when you probably need some advice, is when you first have the conversation, and you don't need to pay for the ongoing advice at that point. It may be just a consultation. And then once you get to the point where you start having to move the puzzle pieces, unless you feel very, very confident, what I would suggest is to find an advisor that you trust and specializes in retirement income.
Fantastic. And the couple of things that I picked out from that, one of them is simply the amount that you are looking to help folks. I mean, just that advice right there, that you might not need to have a consistent advisor from when you are 25 years old until you're 50. I think that is incredibly valuable for folks, because you could spend a lot of money on that advice, at potentially at a time when the most important thing, and I'm recapping a little bit here, but the most important thing from, let's say, 25 to 50 is probably just that you are making consistent, hopefully automated monthly contributions into these accounts that at some point you will be able to utilize. A second thread that I picked up on that seems like an important point is you talked about this distinction between the actual number, the financial readiness, and the emotional readiness. And the piece that I'm curious about there is, I think sometimes, and I'm not sure how much you see this, sometimes we might get to a place of retirement where we have this vision of it that might not be coming from internally. It might just be kind of, I don't know, that's what I see other people do in retirement.
Spot on.
How do you talk with folks about really taking the time to slow down and say, I want to define what my own unique personalized vision of retirement is? How do you even start that conversation? Because it feels like that's an important one before we dive into all the technical numbers.
Right. So that's a great point. And what I tend to do is I try to find out if they're running from work or heading to retirement, if that makes sense, right? So a lot of people say, I'm not happy in my job. And we work with a lot of people who's maybe had some leadership changes, and they've been with the place for 20, 30 years, and it's not as fun as it used to be. And so lots of times we'll have those conversations, and very few people that I work with go cold turkey into retirement. A lot of them do what we call a blended retirement. And I think that's a great way to start retirement, because everybody's got a passion, right? And being in Colorado, being in Golden, they're outdoor activities, a lot of them. So we get folks that, and we were joking about it earlier, but folks that say, you know what, I want to stay busy, and maybe I'm a golfer, or maybe I'm a hunter. So you know what, they get a part-time work at a Cabela's or a Shields or something like that, and their job satisfaction soars. The other thing that's fascinating about it is that once we crunch these numbers, and I go back to them and say, you're at a point where you could retire right now, based on everything we've talked about, you're at a point where you can retire. A magical thing happens for them, because they don't take their current job quite as serious, because they know they could run. As if you go in and your supervisor gets you upset, you know you're at the point where you can pull the trigger. So lots of times we'll have a conversation saying, yes, you're at that point where you could do it. And you know, we do all the probabilities and the science behind it, but you're at a point where you can do this. Now they're not as anxious to leave the job. So it tells you about and you do a lot with emotional, financial kind of conversations and behavioral science and things like that. That's a classic study of it, right? all of a sudden you feel you're not working for them anymore. Every day you go in the office, you're working for yourself. Because the one thing that will bolster a retirement plan the most is working another year. A couple of things happen. Generally, you accumulate more money in your savings. And this sounds a little bit cold, but you're also going to live 1 year less when you look at what you have to cover in retirement. So the math works out.
1 year less that you don't have an income.
Or you're not taking money out. That's correct.
Yes.
Yep.
Okay.
Yeah. So the math goes up quite a bit. But to get back to coming up with a number, and once again, this is oversimplifying things a little bit, but it gets you in the ballpark. What you first have to do is calculate what your targeted monthly income is. And that stops a lot of people right off the bat, because how would I ever know? I just don't know. So what I tell folks to do is go through the needs, wants, and wishes exercise. And it's quite literally get a yellow pad out and put 3 columns: needs, wants, and wishes on it. And whether you go on to your check register or online or whatever it's easier for you, pull up 3 or 6 months of it and just go down the line. And if it's like a mortgage or healthcare or transportation, so usually it's things like food, transportation, utilities, healthcare, housing, those are in the needs column. And while you're going through that, if you're younger and you say, I've got a few years to do this, well, keep an eye on it. Well, maybe the mortgage isn't going to be around when you're targeting retirement, so that doesn't need to go in there. The other ones you always have to account for. And that's really straightforward. A lot of people can do that. And I tell them to do 3 or 6 months worth of the check register, because we're not billed monthly on everything, right? So you get that number, and then you go into the wants column, because I'm a huge proponent of people retiring to something they want to do. You don't want to retire and just keep the lights on.
Right.
That's a miserable existence. So what you want to do, whether it's golf or hunting or traveling or fishing or whatever it may be, build that into your needs column. Going out to dinner, those kind of things.
Seeing your grandkids potentially.
Absolutely.
Get dinner, whatever.
Gifting for
Yes.
some folks. I mean, that's where you do. And I tell folks when they're going through the process, don't do it with too much of a fine pencil, and round up. When in doubt, round up, and don't spend hours and hours and hours overthinking it, because all we want to do is get a start. Just get it out there.
One tool that is extremely useful that all of our OnTop members have access to is within our mobile banking platform. There is a really nice way to go back and look at that ledger, that list of transactions that you've had over the past 3 to 6 months, in a way that makes it not so daunting. You don't have to go pull your credit card statements for the last 6 months or whatever. You just link all your credit card accounts into the app, and it shows you a couple of different formats. There's a nice pie chart. There's a way that you can go back through individual transactions, but you spend maybe 30 minutes on that, and you have a great handle on what my monthly finances are. What are some of those things that might only come up once a year? Maybe you mentioned a lot of folks are athletic and like to get outside. I know a few folks who are 60 years old and they love to go skiing. Well, that ski pass is a once a year larger purchase.
Big spend.
And so you can see that by pulling some of them. You can even go back for the last year and just see, hey, what all is in here, and really quickly get that data rather than having to think through all the details.
Right. I agree. And you were saying that, I was kind of laughing to myself, because I also have some engineering minded clients who are laughing at us right now.
Yes.
Right? They do use a yellow pad and go through this stuff because they've got their Excel spreadsheets and all built up. So, if that's you, fantastic, have at it. But for most folks, at least the ones we come across, this tends to work out a little bit better. And then, so we've got the needs and the wants, and the wishes is where you get a little bit more aspirational. And this is more talking about legacy. What do I want to do with my wealth when I pass? And that's another thing that is a pet peeve of mine, and it's a shortcoming of the industry, because a lot of folks will tell you that you need to spend down your wealth in retirement. If you do it right and you are setting it up correctly, you can live the way you want while still accumulating wealth and be able to leave a legacy, whether it's to your kids, or the grandkids, or to the SPCA, or whatever you're passionate about. It's always better to have more money than less, provided you can live the lifestyle that you want to live, right? So now you come up with that overall number. And I should have prefaced all this because I do see on social media and some of these talking heads that are out there, I'm sure you've seen them too, can you retire on $1 million? Or the right answer to all those, unlike what they say on social media, is it depends. It depends on you, your unique situation. I've had people with a couple $1 million not retire happy, and I have people with 500,000 that are living a very full life and just been fantastic with it. So, and the reason why it's not accurate is because you don't come up with your number. Whoever the person is talking in YouTube or whatever is talking about a number, and it's not your number. So this is how you find your number. You do your needs, your wants, and your wishes. And let's just say that to make the math easy, that comes up to $10,000 a month. Well, the next step in my process is now remove your guaranteed streams of income. So we're fortunate enough, or we work with a lot of folks that are fortunate enough to still have access to a pension.
Yes.
So take out the pension income, take out Social Security. Now, there's a lot of folks that think Social Security is going to go away. I don't tend to believe that. So I still look at that as a guaranteed source of income. And it's a great one because it also gets cost of living adjustments. And very few income products can do that for you. So now let's say you have your 10,000 and you take, let's say, 3,000 out for a pension and another 2,000 out for Social Security. So now you have what I call an income gap of $5,000. That $5,000 is what you have to meet. Now it's less daunting because before you want to get 10 grand and you're thinking all I've got is 600,000, 700,000 in my savings. Can I do 10 grand? Well, you probably can't do 10, but you might be able to do 5, right? So it makes it manageable. So that's our income gap. Now the next step, and this takes just a little bit of explanation, and this, once again, very much a ballpark, but in the financial planning world, there's something called the 4% rule. It's not really a rule, it's a guideline. Yeah. And it basically, there's a fellow named Bill Bengen, I believe MIT, 20, 30 years ago, decided to figure out how much, his question was, what percentage can I withdraw from my savings and not run out of money? And he assumed you're 65 years old, 30-year retirement. Okay. And the number he came up with, he ran 10,000 different iterations, upside down, sideways, came up with a 4% rule. So his 4% is what they call a safe max withdrawal number. So his calculations, and the industry embraced it, is that you could pull about 4% out. So now you have to figure out what your $5,000 per month is as a percentage of where you are or where you plan to be from a retirement savings standpoint. And if that number, if you're going to retire at 65 and that number is less than 4%, you're in the ballpark. Start getting involved with an advisor, have those conversations because you're close. If say you're 50, well, 4% is going to be too aggressive, but maybe 3% is going to be decent, right? Or if you're a little bit older, so say you retire at 70, well, now maybe you can go to 4.5% or 5%. So that gets you into the ballpark. And that's, if you don't have the money yet, it gives you an idea of how many years of growth you need to get there. And so you can bump up your savings rates, or you can go a little bit more aggressive with your investments, those kind of things.
So let's say that somebody understands the general concept here of the 4% rule. Your account is still growing because it's in some sort of a growth account, whether that's a high savings account on a basic level, or whether it's in a total stock market index fund, or whatever it's in.
Right.
It's growing some. And so you can take that 4% out per year and that account will not be shrinking in terms of the dollar amount in it. could somebody who understands that concept but wants to say, okay, now I want to run some scenarios and see what happens if I, increased my contribution to this or decreased it to this or raised my amount that I'm withdrawing instead of using 4%, what if I used 4.5%? Could they run some scenarios with you and see what does that look like and what types of options does that give me if I manipulate some of this?
Yep. So great question. If you find that you're in the ballpark, it's worth having a deeper conversation and getting them, once again, that proverbial pencil sharpened a little bit. Feel free to come on in, give me a call. You can reach me through the credit union, or you can go to retirementwellcrafted.com, and we have tools there as well. But reach out to me, and I have systems that we can input different variables, and it's really quite helpful for the what if scenarios. Okay, because lots of times you're not going to come up with a very, very yes and no answer. You're going to be in a gray area. And it also helps to think out loud. So definitely give a holler, and we can get into it. What we ended up doing is we put the information in, it does some calculations behind the background, and it ends up turning out a little speedometer with a percentage chance of success.
Okay.
And I strive for 100%. That's tough to get because that last 1 or 2% is difficult. But then you're empowered, because let's say you were at 100%, but now I want to take a little bit more out in retirement. And that drops you down to 87% or 85% or whatever it is. A lot of folks in the industry accept a 75% success rate as a positive outcome. But that's up to you and what you're comfortable with. So absolutely, we can cater it to your unique situation.
That sounds like a really valuable and useful tool. And the thing that I love about it is that from what I know about you and the way that you do these calculations, you know that the tool, the calculator, is never the final answer, right? It just gives us some insights into here's the set of possibilities that could occur if I'm doing this right now. And then the whole point of the tool is to be able to engage in those rich conversations about what do we want to do with our money to be able to design.
Absolutely.
And so that's a fantastic resource right there. And for people to be able to really tell you what it is that they want and what they would feel comfortable with, and would I feel comfortable with lowering my chances of success to 85% from, say, 92% because I was able to go on one more vacation a year or whatever that conversation is.
Yep. Without getting too much, because I know we're coming up to the end of the first segment here, but there are spending strategies that we can plug in as well. Some are straightforward. Well, it's an inflation adjusted. It's what they call the retirement spending smile.
Okay.
Where most of the time when we retire, we spend more in the beginning, slows down in mid-retirement, and then the spending picks up on the back end. So we can put in all those scenarios that are unique to you. And then we have people that say, well, I'm going to retire. Looks like I'm going to have an inheritance in 10 years. How do we plan for that? Those kind of things we're happy to help. And conversations are free.
Fantastic. Well, thank you so much, Dave, for being here and providing us with some of your insights into retirement income planning and to help to offer your services, to have members come in and to engage in conversations, to ask themselves, how do we want to use money to design the lives that we want to live?
Perfect.
Awesome.